In this presentation, we will take a look at some of the reconciling items between the methods we have been looking at, the methods we have been proposing. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We've looked at a few different methods, one being a simple method and the other being a bit more complex, meaning we're starting off with a cash basis and keeping it as cash basis as possible, that being the simplest method that we can use. And then we've veered from that from time to time and thought about whether or not we want to take on for the specific needs of a customer or a client some more accrual type processes. You'll note that as we've gone through this, we have some differences in, say, the net income number as well as the balance sheet. We would expect this to be the case because some of the balance sheet items, for example, will be accrual type of accounts. The more we track more detail, the more accrual elements we are putting into the place, and more accounts on the balance sheet will reflect those accrual accounts. And on the income statement, we'll note that the income is different as well. And so let's just take a look at some of those items that will be the differences so far. Once we go through the reconciliations, once we give this information to the tax preparer at the end of the year and think about or have them help us to enter the adjustments at year end for tax preparation or whatever the client's needs are, some of these differences may go away at that time. For now, we just want to keep an idea of what those differences would be, and they're mainly a result of timing differences. That's the difference between the accrual and cash methods. So for example, if we had the QuickBooks 3 file, this is the net income from QuickBooks 3, the more complex method, and we were trying to reconcile to the QuickBooks 1, the method, the simplified cash method. What are some of those differences that would be? So this is net income on the bit more complex method. Some of the differences result in insurance expense recorded under QuickBooks 1 at the time it was paid. So you recall that we recorded insurance expense when we paid it under kind of the simplified method and expensed it, as opposed to putting it on the income statement, on the balance sheet for it to be allocated over the time period. And so that means that we had this huge expense in January under the simplified method because that's when we paid it. So that's going to be one of the differences between a cash method and a more accrual method. Which is correct? Well, on a cash flow basis, it would be correct to expense it, but really it would be more correct on an accrual basis to see it allocated over for comparison purposes, and it just depends what we want to do with it. If we're doing something with taxes, really the question is it tax deductible, not really is it appropriate or not. So that's what we need to do. We just need to note what that difference is, and that's why we're going to give it to the adjusting department people at the end of the period so they can do what they want, whether it be tax preparation, that's the end goal, or some other type of accrual financial statement that's the end goal. Our goal is to get it in there as easily as possible and let the adjustments be made for whatever the end purpose is. So separate our duty from whatever duty there is in the period end adjustments, or make our own period end adjustments to make these adjustments. Credit card balance, not expensed under Q1. The most easy way that we deal with the credit cards is to just make the payment and record it to credit card expense. And again, rely on that adjustment to be made at year end or at period end. And the reason for that is because if we don't pay off the entire credit card, then we're going to have an accrual thing going on here because there's going to be a liability that we owe. So we can't record the entire thing under the simplest method. If we want to be on a complete cash basis method, it's easier for us to try to basically eliminate the credit card or just record it as credit card expense. And that results in this difference that would be adjusted for, hopefully at the end of the time period when we allocate those credit card expenses to, again, whatever our needs are at the end of that time period, whether it be tax, financial statements for other purposes, accrual financial statements versus tax financial statements. Then we have interest expense not recorded under QuickBooks 1. This would be the interest on the loan. And you remember under the most simplified method, what we're just going to do is just record the loan payment as a reduction to a loan, a liability, and not break out the interest component because it would be more complex to do that. We would need an amortization table. So again, we're going to provide that amortization table or ask for the amortization table to be done by the accountant at the end because they may have to generate from the loan documents. We'll give them the loan documents, allow them to enter that adjustment, So that's the result of this difference that could be adjusted for, again, depending on our needs at the end of the time period. Then we've got payroll taxes not expensed under QuickBooks One. When there is payroll, if we're just recording the net check, note that we're just going to record the net check, which is net of the liabilities. Now, we may record the payroll tax expense on a cash basis, but it's not going to be until we pay them. So there could be this timing difference as a result of that, meaning we're incurring the payroll liabilities, but we're not paying them yet. We haven't yet paid the payroll liabilities, and therefore it's not on the income statement yet under the cash basis method. So just a few things to kind of be aware of. And if we reconcile this out, if we take this number and add and subtract the information, we get to the QuickBooks balance for net income on the easy method. I think we might still be off by $50 or so. This is just going to give us an example or some of the items that are going to be reconciling items. Now, when we go through just the idea of the reconciliation process, some of the adjustments that might be made that we're not going to make, but we're depending on the adjusting department, the tax preparer or the accountant at the end of the year, whoever's making the financial statements. Once they do that, then some of these reconciliation differences may take care of themselves after that point. But again, it really depends on the needs of what the documents are at the end. So just be aware then, under the different methods, because of the different timing differences we will have these changes. And what we're doing is planning in some way to have the adjustments be made at the end so we can make it as easy as possible to tweak our numbers to whatever needs to be done, whether it be taxes, whether it be accrual-based financial statements. For more accounting information and accounting courses, visit our website at accountinginstruction.info.